Between October 1st, 2024 and November 15th, 2024, roughly 37.6 million ounces of silver disappeared from COMEX vaults, a drain that wiped out about 47% of all registered silver in just 47 days, the biggest drawdown since the year 1980. The same year silver rocketed to around $50 per ounce. COMEX changed its trading rules in the middle of the move to stop the Hunt brothers, and the entire futures system nearly imploded. But what almost nobody discusses is that the Hunt brothers were not simply trying to corner silver to get rich. They were attempting to blow open a manipulation that had been operating for more than a century, and the system crushed them to protect itself. On February 14th, 2025, 4 large South Korean banks suddenly halted all silver sales. Not a partial reduction, not a temporary pause, but a complete, indefinite stop. At the same time, China blocked its citizens from purchasing physical precious metals through domestic banks. Russia was pushed off London bullion trading floors, and right now the market is displaying a signal that breaks basic pricing logic, with spot silver trading above futures contracts, a condition called backwardation, which in simple language means people are willing to pay more to obtain silver immediately than to accept a promise of delivery in 6 months, something that should not persist in a healthy market and only appears when the real metal is scarce and paper promises have lost credibility. This story is not about silver simply rising in price. It is about a 150-year program of price suppression starting to fail in real time, and when it fails fully, physical silver will not just be costly, it may be unobtainable at any realistic price. So to understand what is happening, you have to see how central banks, bullion banks, and exchanges have controlled silver for more than a century, why they needed to keep it cheap, who gains from that suppression, what the Hunt brothers uncovered in 1980 that nearly exposed everything, and why the present supply crunch is unlike any previous episode, because this is not merely a story about trading opportunities. It is a window into how the wider financial system conceals inflation, defends the dollar, and quietly drains wealth from anyone who trusts layers of paper claims rather than real assets. Before you can grasp the mechanics of manipulation, you need to understand why silver matters more than almost any other raw material on the planet, since gold functions primarily as money and a store of value, sitting in vaults and on balance sheets, while silver is both money and an essential industrial metal woven into the fabric of modern life, embedded in smartphones, indispensable for solar panels, used in electric vehicles that require roughly 3 times as much silver as traditional combustion engine cars, built into medical devices, exploited for its antibacterial properties, integrated into 5th-generation communication hardware, guidance systems, missile electronics, and semiconductors, so that nearly every technology that defines advanced civilization depends on it. And unlike gold, which is hoarded and recycled so that almost every ounce ever mined still exists somewhere, silver is consumed, spread across landfills and electronic waste, diluted into products that will never be recovered economically. For 4 consecutive years, the world has been running a silver supply deficit, with about 148.9 million ounces more being used than mined in 2024 alone, meaning that the shortfall is being covered by drawing down old stockpiles, commercial vault holdings, and government reserves that took decades to build, and those buffers are shrinking rapidly, while researchers at the University of New South Wales have warned that the solar panel sector alone could devour between 85% and 98% of known silver reserves by the middle of the century if trends continue, all while mining output declines or stagnates as ore grades slip and new projects lag. So if silver is this strategically important, this finite, and this central to technology and energy transition, the obvious question is why its price has not gone vertical already. And the answer is that the price has been held down deliberately for more than 1.5 centuries. The story does not begin with the Hunt brothers in 1980, or with President Richard Nixon closing the gold window in 1971. It begins in the 19th century with what critics called the Crime of 1873, when the United States Congress passed the Coinage Act of 1873 and quietly stripped silver of its monetary role, ending the bimetallic standard under which both gold and silver coins functioned as legal tender and could be freely exchanged, because leaving silver as money would have expanded the money supply as huge new deposits from places like Nevada flooded the system, causing prices to rise and making it easier for debtors to pay what they owed, something lenders and bankers opposed fiercely, since creditors, banks, and wealthy bondholders benefit from deflation and scarce money that keeps debts hard to repay and interest flows steady, while farmers, workers, and small business owners wanted silver monetized to ease their burdens. The demonetization of silver quietly shifted wealth from borrowers to lenders under the guise of technical monetary reform, leading to deflation, collapsing agricultural prices, widespread foreclosures, and richer banks, and by 1900, William Jennings Bryan was running for president on a promise to restore silver to monetary status, giving his famous Cross of Gold speech, in which he declared that mankind should not be crucified on a single metal standard. But he lost, silver stayed out of the core system, and the gold standard held firm. Even so, silver remained embedded in everyday money, since United States dimes, quarters, half dollars, and full dollars were 90% silver until the mid-1960s, and by 1964, the market value of the silver in a coin was beginning to exceed its face value, with a silver quarter containing around 18 cents worth of silver, when the metal price approached $129 per ounce, encouraging people to melt coins for profit, which spooked the government because if circulating coins were worth more as raw metal than as currency, the entire coinage system would unravel. So in 1965, Congress passed the Coinage Act of 1965 and removed silver from circulating coinage except for half dollars, which were watered down to 40% silver. And rather than allow silver to float freely to its true market level, authorities started dumping silver from strategic reserves to push prices back down, unloading billions of ounces between 1965 and 1970, in part because a rising silver price would signal real inflation and weakening confidence in the dollar at precisely the time when the United States was printing aggressively to fund the Vietnam War and Great Society programs. By 1971, when Nixon severed the last tie between the dollar and gold, both gold and silver were flashing the same warning that the currency was being debased, but instead of acknowledging the message, policymakers leaned on a growing paper market to control prices. Once silver had been cut off from coins and the underlying monetary system, Wall Street and major exchanges could build an elaborate derivative structure over the physical market, with futures contracts on COMEX allowing traders to speculate on silver prices without ever touching the metal, XT. And traded funds like SLV offering exposure without delivery, and layers of certificates, allocated and unallocated accounts, and complex derivatives piling claims onto a limited pool of real bullion. The architecture of the scam looks like this. A bullion bank such as JP Morgan might hold 10 million ounces of physical silver in its vaults, but instead of selling those 10 million ounces once, the institution creates perhaps 50 or 100 separate paper claims against the same pile, issuing futures contracts representing hundreds of millions or even a billion ounces, selling ETF shares supposedly backed by that same metal, and engaging in swaps and structured products with other banks that all rest on the same physical base, so that for every ounce in the vault, there might be 50 to 100 promises. And as long as almost nobody insists on delivery, the system continues. The bank collects fees and interest. The apparent supply of silver looks enormous, and any time the price starts to break upward, huge waves of paper contracts can be dumped on COMEX to push prices down and discourage physical buying. This is not random behavior, but part of a coordinated structure involving central banks, the Bank for International Settlements acting as the central bank of central banks, the London Bullion Market Association as the opaque hub of over-the-counter gold and silver trades dominated by a handful of major banks such as JP Morgan, HSBC, and Goldman Sachs that often hold massive short positions in silver, and COMEX in New York, owned by CME Group, which sets the rules for futures trade and has the power to rewrite those rules whenever they threaten the stability of the system, as happened dramatically in 1980 when Nelson Bunker Hunt and William Herbert Hunt, wealthy Texas oil heirs, started accumulating silver in earnest, not as a simple speculation but because they believed the dollar was collapsing under double-digit inflation of around 13% after Nixon ended the gold convertibility and saw silver, which had functioned as real money for roughly 5,000 years, as protection. The Hunt brothers acquired about 200 million ounces, roughly half as physical bullion and half via futures contracts, using margin to control vast quantities with relatively modest upfront cash. And crucially, they took delivery, pulling silver out of COMEX vaults at a rapid pace, so that in January 1979, silver traded near $6 per ounce, climbed to around $10 by September, then to $30 by December, and finally peaked around mid-January 1980 at roughly $4,945 per ounce, according to the price notation in the records. making the Hunts among the richest individuals in the United States on paper, and terrifying Wall Street because continued deliveries could have drained COMEX entirely and shown the world that the huge futures market was not fully backed by metal. The exchange responded in a way that reveals how the game works whenever the structure is threatened, announcing in early January 1980 a new Silver Rule 7 that effectively stopped traders from opening new long positions, permitting only selling or holding, which targeted the Hunts and anyone aligned with them. And when that did not break the rally quickly enough, COMEX hiked margin requirements by several 100%, forcing the Hunts to come up with hundreds of millions in additional collateral overnight, which they could not do in time, leading to forced liquidations and a spectacular crash on what became known as Silver Thursday, March 27, 1980, when silver fell from around $21 to roughly $10.80 in a single session, wiping out an estimated $1.7 billion of the Hunts' wealth, pushing them into bankruptcy, and nearly toppling several brokerage houses until the Federal Reserve stepped in to stabilize the system. The key point, however, is that those who had bought physical silver and simply held it were not wiped out, since post-crash prices remained far above the $6 levels of early 1979, so that holders of physical metal still enjoyed large gains, while the Hunts were destroyed precisely because they trusted a leveraged, rule-changing system. In the aftermath, the silver price was pinned between about $4 and $8 per ounce for roughly 2 decades, despite rising industrial use, as central banks sold reserves, leased metal to bullion banks that dumped it into the market, and allowed uncontrolled expansion of paper claims, with manipulation so blatant that in 2004, a group of investors filed a class action suit against JP Morgan and HSBC, alleging coordinated suppression through massive short selling on COMEX. And in 2020, JP Morgan ultimately paid about $920 million to settle charges brought by the Department of Justice and the Commodity Futures Trading Commission for spoofing and other forms of precious metal price manipulation, proving that this was not a mere conspiracy theory, but a documented pattern of abuse, though the fine amounted to less than a year of profits and did not end the behavior. Suppression persists because bullion banks profit from repeated cycles of engineered declines, and deeper still because central banks and monetary authorities require subdued gold and silver prices to maintain faith in fiat currencies, since surging precious metals make it obvious that official inflation numbers are understated and that currencies are being debased, pushing people out of bonds paying 4% and into hard assets that might appreciate 20% or more annually. So keeping metals artificially cheap is fundamental to preserving confidence in the dollar, the euro, the yen, and the rest of the fiat complex. But that strategy rests on one crucial assumption, that there is enough physical metal to back all the paper and supply all the industries that need it. Today that assumption is collapsing, as shown by COMEX's own data, where on October 1, 2024, there were about 80.6 million ounces of registered silver, meaning metal explicitly available for delivery against futures contracts, and by early December 2024, that number had dropped to around 43.2 million ounces, a decline of about 37.4 million ounces in just 47 days, including withdrawals like roughly 6.3 million ounces taken out on November 17th and another 4.8 million ounces on November 21st, a pattern far more consistent with a bank run than ordinary profit-taking, with total vault holdings of roughly 265 million ounces split between registered and eligible categories, but only the registered portion actually available to satisfy delivery requests, while open futures contracts represent several 100 million ounces, so that if even around 20% of contract holders insist on delivery, COMEX does not have enough metal. This time, unlike 1980, it is not merely 2 wealthy speculators trying to stand for delivery, but a global mix of sovereign entities, industrial users, and private investors who want metal in hand. And the warning signs are spreading, with the February 14, 2025 decision by Shinhan Bank, KB Kookmin Bank, Hana Bank, and Woori Bank in South Korea to suspend silver sales entirely, a move that signals real scarcity across sophisticated supply networks, while China has tightened restrictions on citizens buying gold and silver through banks and appears to be accumulating metal at the state level. India has ramped silver imports to record levels as a population well acquainted with currency turmoil shifts savings into tangible assets, and Russia, barred from the London bullion market since 2022, has continued adding to central bank gold reserves each year since 2006 and is clearly pursuing de-dollarization through hard asset accumulation. The clearest immediate symptom that the system is breaking is persistent backwardation in silver, where spot prices exceed futures prices, inverting the normal structure in which contracts for future delivery trade at a premium to reflect storage, financing costs, and time value. So when investors and industrial buyers are willing to pay more for immediate physical metal than for a promise 6 months out, it signals not just tightness, but a profound lack of trust that the metal will be available later, meaning the paper price is no longer believed, and physical buyers are desperate. This is the same underlying stress that nearly broke the system in 1980, except now it is distributed across nations and industries rather than concentrated in the hands of 2 men. And while in the earlier episode COMEX could change margin rules and restrict purchases to contain the threat, it cannot easily rewrite reality for an entire world that wants delivery. So the exchange faces a limited menu of options, raising margin requirements so high that speculative longs are forced out, which may thin out traders but does nothing to conjure new metal, or moving to cash settlement, in which futures are paid off in dollars instead of silver, which would generate lawsuits and destroy market credibility, or allowing prices to explode as physical demand overwhelms supply. In the final stage, you would expect to see frequent trading halts justified as technical glitches or volatility controls, increasing incidents of delayed or failed deliveries, exchanges quietly pushing large players toward cash instead of metal, widening gaps between official spot prices and what dealers charge for real bullion, with premiums that could take a nominal $60 spot price to $90, $100, or $120 in the physical market, and eventually a point where no amount of money can secure sizable quantities of silver because inventories are empty and mints are backlogged for months or years, at which moment futures contracts, ETF shares, and certificates tied to silver become little more than paper, while only actual ounces in private possession retain full value. This dynamic has emerged before in other commodities where paper leverage outran physical supply, as with palladium in the early 2000s when prices jumped more than 263%, in roughly 2 years after Russia, which controls around 60% of global supply. Disrupted shipments and physical availability vanished, leaving futures traders who could not take delivery exposed, while holders of physical palladium saw dramatic gains. And similarly, when Nixon ended dollar convertibility into gold in 1971, under pressure from foreign central banks demanding metal for their dollar reserves, effectively defaulting on the Bretton Woods promise and triggering a gold run from $35 to around $850 over the following decade, a move of about 20,400% that simultaneously crushed the purchasing power of paper dollars relative to gold. The pattern is always the same: a buildup of paper claims, growing demand for physical delivery, an eventual break where contracts cannot be honored as written, and a revaluation in which hard assets reveal how mispriced they were under the old regime and the arithmetic around silver. Today suggests we are nearing that point, with global mine production around 830 million ounces per year, industrial demand near 620 million ounces, investment demand around 300 million ounces, for a total of roughly 920 million ounces of annual demand against 830 million ounces of supply, leaving a gap of about 90 million ounces that must be met from above-ground stocks that are visibly shrinking as COMEX vaults empty, state reserves are accumulated, and private hoards tighten. Once those stockpiles are gone, the only way to supply new demand is to mine more, something that cannot be accelerated quickly because opening new mines takes many years, and existing deposits are declining in grade, and no central bank or government policy can create metal out of nothing, since you cannot print ounces or legislate new ore bodies into existence. So the long-running manipulation that relied on abundant supply is colliding with the physical limits of the resource. This does not mean you should rush into silver as a speculative trade for fast profits, but it does illustrate a recurring historical truth. Every fiat currency ever created has eventually failed, with an average lifespan of about 27 years, while the United States dollar has floated without metal backing since 1971. More than 54 years, and in every such regime, when confidence erodes, people flee toward hard assets like gold, silver, real estate, and essential commodities, favoring things that cannot be devalued by decree, and silver holds a unique place at the intersection of monetary refuge and industrial necessity, crucial to green energy infrastructure, electronics, and communication systems, all while governments continue trying to suppress its price, because a soaring silver chart would loudly expose the scale of currency debasement. The Hunt brothers, in 1980, inadvertently demonstrated that the system could not withstand large-scale demands for physical delivery, and they were broken because they used leverage and believed the rules were neutral. But 4.5 decades later, the same structural weakness is reappearing on a far larger SE, Kale, driven not by two wealthy traders, but by country-level policies in China, India, and Russia, by institutional buyers, by industrial users, and by millions of individuals who no longer trust paper claims, as seen in the COMEX vault drain, the South Korean banking suspensions, Chinese restrictions, and the persistent backwardation in silver markets, all of which are red lights on the dashboard of a system under strain. When the situation finally reaches the point where the paper market can no longer be maintained by shifting rules, the result will not merely be a higher quoted price, but a bifurcated reality in which official prices apply only to contracts that settle in cash, while real metal trades in a much tighter, more opaque physical market where availability, not spot quotes, dominates, and those who hold silver in their own possession find themselves insulated from a failure that will leave many holders of paper claims with much less than they believed they owned. The historical milestones tell a single story, from 1873, when silver was demonetized in favor of creditors, through 1971, when the dollar severed its last link to gold and metals signaled the shift, to 1980, when the Hunts exposed how fragile the paper system truly was, and now to the years around 2025, as physical supply limits collide with a century and a half of suppression, and this time the system cannot simply rewrite the rulebook for two isolated speculators, because the imbalance involves entire nations and industries, and the scale of the adjustment will be determined not by what exchanges declare, but by the hard fact of how much silver is left in the real world.